Hello there, fellow financial adventurers. Welcome back to Investing Lighthouse and our incredible community of money mavens and wealth wizards. Whether you're an experienced pro or just beginning your investment journey, you've come to the right place. This is your one-stop shop for financial know-how and money-making tips. So get comfortable, grab a snack and buckle up because today's journey will take us deep into the fascinating world of behavioral investing. Before we embark on this exploration, let me introduce you to Dr. Daniel Crosby, who will guide us on this intriguing journey. Crosby is a renowned psychologist and behavioral finance expert who's made a name for himself by delving into the intricacies of understanding the complex relationship between our minds and money. His keen insights and breakthroughs in the field have cemented his reputation in the world of finance. One of his greatest hits, the enlightening book, The Behavioral Investor. Daniel Crosby's The Behavioral Investor is a tour de force that delves into the abyss of our mental and emotional quirks, shedding light on how they play out in our investing habits. And we'll explore these key insights today, breaking down the 7 main takeaways from Crosby's investment opus. Crosby firmly believes that human brains, while remarkable and intricate, tend to be our worst enemies when investing. This stems from our evolutionary biology and the survival instincts ingrained within us. First up, we have biases. These mental shortcuts have allowed our ancestors to survive the dangerous prehistoric world, but they don't serve us well in the financial jungle. For example, our negativity bias helped early humans to err on the side of caution, prioritizing bad news as a matter of life and death. Handy when you're avoiding saber-toothed tigers, but not so much when you're investing, and knee-jerk reactions to bad news lead you to make irrational decisions. Let's now consider the confirmation bias, our tendency to favor information that confirms our beliefs. Picture this: you've invested in a tech stock, and despite market analysis waving red flags, you only pay attention to the positive news. Your brain is effectively filtering information and leaving you blinkered, a dangerous state in the dynamic world of investing. Another one is the anchoring bias, which refers to our tendency to stick to an initial piece of information, even when new information suggests we should change course. Suppose you purchased shares of a company at $100 per share, and it drops to $50. You might still cling to the belief that it's worth $100. On the other hand, recency bias is our tendency to focus on the most recent information, forgetting the bigger picture. If your favorite tech company just released a groundbreaking product, you might be tempted to invest heavily, forgetting the company's shaky financial health. Secondly, Crosby highlights our emotions' profound impact on our investment decisions. They are also the hidden drivers behind every impulsive investment decision. Feeling scared or greedy can lead us to make rash decisions that sabotage our financial goals. Take the 2008 financial crisis, for example. Fear and panic led many to sell stocks at rock-bottom prices, only to miss the subsequent recovery. It's a wild ride on this emotional roller coaster, but understanding this can help us stay level-headed, even in the face of market turbulence. 2 common emotional pitfalls in investing are greed and regret. Greed, like the gold rush era of the 1800s, can cause investors to pour money into the latest hot investment without considering the risks. And then there's regret, that sinking feeling when you realize you've missed out on a lucrative opportunity. You might decide to jump in late to avoid future regret, only to find that the trend has already peaked. Third, Crosby emphasizes the power of context. It's a wild world out there, and the societal, political, and economic landscapes we find ourselves in can significantly influence our investing behavior. During bull markets, for instance, the widespread euphoria might make us ignore warning signs, inflating dangerous investment bubbles like the dot-com bubble of the late 90s. Another example that illustrates the power of context is when investors often flock to so-called safe haven assets like gold during times of political instability, which causes gold prices to spike. Alternatively, media hype around a new investment trend, like cryptocurrency, can cause a rush of novice investors hoping to strike it rich, driving prices to unsustainable heights. In the world of investing, ego can be your downfall. The overconfidence bias often leads us to believe we're above average and can outsmart the market. Our belief in our investing prowess can be a stumbling block. Consider a day trader who, after a string of successful trades, believes they can outsmart the algorithmic powerhouses on Wall Street, only to end up losing big. There's also the illusion of control bias, where we believe we can influence outcomes that are, in reality, beyond our control. If you've ever found yourself urging a stock price to rise, you've fallen into this trap. Remember, the market doesn't care about your self-esteem, so it's essential to stay humble, keep learning, and understand that investing isn't a solo sport, but a game of probabilities. Our fifth insight is about the risks of being too conservative. Evolution has wired us to stick to the safety of the known, the comfortable. It's the fear of loss that keeps us in the safety zone. It's like keeping all your money in a low-yield savings account because you're too scared of the riskier stock market. Or, imagine that you've always invested in bonds for their safety. But as inflation suddenly surges, your portfolio will struggle as inflation eats into your purchasing power. As you can see, being overly conservative in investing can lead us to miss out on significant opportunities for growth. Adaptability is the MVP in Crosby's playbook. Sure, we might make investment blunders due to our hard-wired biases and emotions. Still, adaptability is our saving grace as we can learn from our mistakes and adjust our strategy accordingly. You may have invested in a company without doing proper research and suffered a loss. Instead of wallowing in self-pity, adaptability means using this experience to improve your research skills for the future. Or maybe you sold shares during a market dip only to see prices bounce back. Instead of dwelling on the loss, turn it into a learning experience. Finally, Crosby argues that discipline is an investor's best friend. With all the chaos and unpredictability in the market, the ability to stick to a well-thought-out investment strategy despite short-term market fluctuations or personal circumstances can yield significant long-term dividends. It's like sticking to your workout plan, even when it's cold and rainy outside. To overcome these challenges, Crosby recommends a few strategies. Overcoming ego involves recognizing our limitations and maintaining humility. We must accept that we can't control everything and be willing to learn from our missteps. Conquering conservatism means balancing our desire for safety with the need for growth. We must understand the role of the risk in investing. Without risk, there can be no reward. Honing attention requires us to be mindful of the broader context, rather than focusing on single data points. It is essential to train yourself to look beyond the latest news. Remember, sound investment decisions are based on comprehensive analysis, not headlines. Managing emotion involves developing emotional self-awareness and regulation strategies, essential tools for every investor. Using tools like meditation or mindfulness practices could be beneficial to control your emotions effectively. Remember, when it comes to investing, cool heads always prevail. Crosby also asserts that rule-based investment decisions help behavioral investors succeed. This approach removes our emotional and cognitive biases from the equation, ensuring a rational and consistent investment strategy. Consider, for example, The dollar cost averaging strategy, where you invest in a fixed amount in a particular investment at regular intervals, regardless of the price. This rule-based approach ensures you acquire more shares when prices have dropped and fewer when prices have increased, removing emotional decision-making from the process. And there you have it, folks. Crosby's insights help us understand that to master investing, we must first master ourselves. Remember, the journey to financial growth is also a journey of personal growth. Here's to becoming more self-aware, adaptable, and disciplined investors. Have you identified with any of these biases or traps in your own investing journey, or discovered some unique ways to tackle them? We're excited to hear your thoughts in the comment section, as your experiences could help fellow viewers navigate their financial path. And, of course, if you found this discussion enlightening, enjoyable, and valuable, be sure to leave a like. It's a small action, but it helps us bring more of such content your way. Finally, if you're not yet part of our community, don't hesitate to click that subscribe button. Stay curious and vigilant, financial voyagers. We've only just begun our journey of exploration together. Until next time, keep learning, keep investing, and keep growing.